Karthik, why don't we start with you? You saw where we started off with this idea of moving towards some kind of standardized metrics, numbers, platform, visibility. It's something of a green nirvana, at least for accountants and numbers nerds. What do you think of this? What's the conceptual framework we should have in mind when we think about this?
Sure. So, let me take you back to the 1920s, where we had this roaring stock market, and there was this famous moment, perhaps apocryphal, just before the crash of October 29, when Joe Kennedy, one of the richest people in the world at the time, sold his entire equity portfolio. And people asked him, well, why did you sell your portfolio? And he said, well, because the cab driver was giving me stock tips, and I knew that this was just all about to fall apart. And then we had the crash in 1929, and we had the Great Depression that came after it. And part of the problem there was that in that period, the Roaring '20s, although we had companies reporting financial information, there was no such thing as an accounting standard. Nobody had bothered to define what an asset is. Nobody had bothered to define what a revenue is. Nobody had bothered to define what liabilities are or when you would impair an asset. All the basic things that you consider sort of taken for granted. And then, in the early 1930s, the U.S. Congress passes the Securities and Exchange Act, and we create the Securities and Exchange Commission. This is a remarkable period of 6 years, from 1934 to 1940, where we basically have a consortium from government, from industry, from the accounting profession, from academia, that go about doing all of these things we today consider self-evident, like what is an asset, what is revenue, et cetera, all that stuff. And on that infrastructure of accounting information, today sits a capital market economy of $100 trillion, right? And now most of the equity in the world today is passive equity. About 70-80% of it is passive. You're not actually, following what's happening in the companies, et cetera. You've got it in a portfolio and it's just sitting there. But that whole system works because although companies are out there, saying, I've got the best product in the world and I'm going to make $1 kajillion next year, et cetera. At the end of the day, everything comes home to roost in that financial accounting system that sits at the bottom of it. It's the bedrock on which our economy is based. We need that in the carbon world. Because right now, we have this elaborate sort of almost performative system of disclosure where, companies are telling us all the wonderful things they're doing, et cetera, some of which may be true and some of which might be bogus. But there's no basis on which they're held to account. And that's what we're trying to do. That's what we're trying to create right now. And we're trying to recreate that moment 90 years later in the carbon world and say, what do carbon accounting standards look like? And these guys have been great partners in it.
So I'm sold on your vision. Yep. Give us a little teaser of how we actually get there.
Yeah. So last week, we just ran a conference where we had maybe a dozen or 2 dozen central banks in the room, as well as about 100 that were zooming in from around the world. So there's a series of sort of stakeholders we need to convene. One of the reasons we've started with central bankers is they care about good data and they're less political than finance ministries and so forth. So we're starting with them because they're really important. They will help us sort of drive this momentum. At the same time, when we first published the first article on carbon accounting, it said, look, what the world is doing is great, but it's disclosure. This was about 3-4 years ago. But now we need to move from disclosure to accounting. We need to sort of start being serious about this. One of the first people to call me after that was the then chief learning officer at SAP. He was a guy, Max. He was my student from 20 years ago. He'd read the paper and he said, this is a great idea. We should put this into place at SAP. I said, come on in, join the. So now SAP is doing this, but there are some of their competitors that are doing it as well, which is great. Because the more of the ecosystem there is on the supply side, the better. We also have Thomas, for instance, from BMW, who's joining. But there are a number of other companies. There's Tata Steel, Hitachi, Heidelberg Cement, some of the big oil and gas companies, Chevron, et cetera. There's Ian here in the room, who is from IDG Security. These are sort of a range of companies that are in various stages of piloting this. So part of that vision is it takes a village. You've got to have the companies, or including high sort of direct emitting companies like fossil fuel companies, steel, cement companies, et cetera. They should be piloting this to answer that question that was asked about how do you get really good primary data into the system? Because otherwise, any system is garbage in, garbage out. So we start with those direct emitters, and we're getting really good primary data. You need the information intermediation companies like SAP that are capturing that data and verifying it at, or not verifying, but capturing it at source, and then allowing it to seamlessly move through an ecosystem. Then you need the assurance providers, the PwCs, the EYs, Deloittes, et cetera, of the world, to be verifying that information as it goes into the system so that then it can travel through them. You need the central banks that we were talking to last week, because, effectively with financial accounting, everything works on the monetary system. So we've got something called money, which central banks issue. We don't have the equivalent of a carbon currency yet, but the central banks are going to have to create that. So that's where they come in. And that will involve some element of tokenization, whether it's a distributed ledger technology or something else remains to be seen. But there are different competing technologies out there. So it's going to take a village. What we do is we're a not-for-profit. I'm an academic. We've created this not-for-profit institute. We have no commercial stake in this at all. We are simply there to bring all of these players together and say, let's make this happen. Let's move. It's going to be, it took us 6 years to do this in the financial accounting world, 90 years ago. Hopefully it doesn't take us 6 years to do this. Maybe 3 years is an ambitious target, but we started and we need to get it done.
All right. So that's a pretty sweeping vision. So here you got the full details here. You called out BMW as a participant in this effort. So maybe I'll come to you, Thomas. If you can give us an idea of how is that pilot going, and maybe take a step back. What is the interest that BMW has in a project like this and trying to do this? Why is this important for you? How does it fit in with your strategy, or what pressure are you facing to do it?
Yeah, thank you. In the old days, where we had one drivetrain technology, there was one thing that matters when it came to the carbon emissions of a car maker. That was fuel consumption times the carbon footprint of the fuel. That was it. Today, with electrification, things get way more complicated. For an electric vehicle, you have to answer the question, what kind of electricity goes into it in the use phase? But if you look at its full life cycle balance sheet, the even more important piece of the equation is, how was it made? How much embedded carbon do I have in the parts, namely in the battery cell, which adds a huge chunk of highly energy intense products that go into a vehicle that haven't been part of it in the past. So having said that, it means that we have to have new tools in order to measure, not assess, measure the carbon footprint of our supply chain. So in the aforementioned old days, when you compared, for example, a diesel to a petrol car or different levels of hybridization, you could use average values that you can purchase. You could do a life cycle assessment and then say, okay, this is presumably the better way forward. But when we talk now about decarbonizing our supply chain, it is about telling the real figure. It is about choosing between supplier A and supplier B. It is different decarbonization options. For example, renewable energy used in aluminum versus higher scrap rates in steel, which compete for one thing. That is the euro that we get once from our customers. So that means from a managerial and controlling perspective, in order to steer right, we cannot depend any longer on average values. We need to have the primary data, as Karthik has been saying. And this is also only a matter of fairness for our suppliers. They want their investment to pay off. They want it to pay off in terms of money. They want it to pay off in terms of the impact on our carbon footprint, no matter where they are. And that means that methodologies which make sure that these differences are made visible and understandable in a relatively easy manner is crucial. And what we have today is, in many cases, reconstructing a carbon footprint from the end downwards into the chain. That is what we have been doing for years. But it needs to work the other way around. We need data that is produced on a reliable basis, measured, and then allocated to the product that we buy. And we need to be able to rely on it being audited and trustworthy, exactly like we do it with financial figures. And final word, BMW 3 years ago abandoned the pathway of a separate reporting on sustainability. We now have an integrated report with one audit, one auditor, and the same criteria at the end of the day being applied to financial and non-financial data. And here we very clearly see the gap between the world of financial accounting and the reality of carbon assessment. And we need to overcome that. We work heavily on that. We have a growing volume of real data that we gather from our suppliers, but we need to move steps forward and move into a world of real carbon accounting. And this is why we are supporting what Karthik is doing. And this is why we are testing the data availability and the procedures to calculate for our products.
That's great, Thomas. So a very interesting case study. I heard a couple of things there that struck me. One, that you're willing to experiment to try to figure this out. That's interesting for a big company like yours that has a lot of value at risk to experiment. A second, that you want to move off of those average values and imputed values to real values. That's one of the problems that we have, of course, up and down the supply chain. Being a very large company, you're able to have some power over your suppliers to perhaps persuade them to participate in some of this exercise. But for me, the third thing that's closest to my heart is getting away from having those separate sustainability or CSR reports. I can remember stacks and stacks of these glossies would arrive on my desk every year, and we all know they amounted to very little in the end. Integrating it into financial accounting, having it supervised, CFO and C-suite sign off on it. To me, that's maybe the most powerful change. If it's happening and it's more widespread, that we can see the integration of green accounting into something just called accounting and accountability. That sounds like a step forward to me. So thank you for that. Let's see what the world of package delivery can do, if you'll allow me, Stephanie, to get a glimpse into Geopost. Now, not everyone will know Geopost, although some of you will. Give us you're the largest mover of packages in continental Europe, is that right?
Correct, and thank you for this invitation. Particularly honored to be with you today as a CFO. Geopost, in a nutshell, we are 100% held by the French Post. We represent half of its revenues, reaching at the end of 23, 15.7 billion euros of revenues, 2.1 billion of parcels transported all over the world through 50 subsidiaries all over the world, and we are number one of parcels delivery by road in Europe.
Even Jeff Bezos is impressed.
Thank you, Vijay. As you understand, of course, our industry is part of the problem, of the environmental problem. As you may know or not, transport logistics represents today 7 to 8% of the global GHG emissions in the world. So at Geopost, and it didn't started yesterday, but a decade ago, we definitely want to be part of the solution. So we started the journey decades ago, and last year we fully integrated sustainability in the roots of our strategic plan, totally embedded with our business ambition. We submitted a trajectory, a carbon trajectory to the SBTi, which was approved in 2023 with really high level of ambition, being net zero by 2040. And to achieve and deliver this particularly ambitious trajectory, we built within Geopost some tools to be sure that we correctly monitor and deliver our targets. And this supposes to embed those processes hand in hand with finance.
What's an example of a tool that you're talking about?
First example, budget carbon. The carbon budget, we put it in place this year for the first time, just to illustrate every year with all of our subsidiaries, we had a financial dialogue to set the financial targets, EBIT, level of investments. This year, for the first time, our sustainability officer was present with me to be part of the discussion and to set not only financial targets, but to set a maximum envelope of CO2 emissions for each of our BUs. And beside that, we defined exactly for each and every BUs an amount of investment to make them able to achieve their target. So investment in terms of expenses, but also industrial investments like hubs, depot, or electric vehicles, the fleet that transports the parcels.
Now, the fact that you're CFO gives me a lot more confidence when you say that the money was allocated to do this rather than if we had someone who didn't have your authority. So you do take account of the investment that's required to achieve some of these goals, obviously.
And this is not an easy discussion, to be fully transparent and realistic with you, because we are all in the same challenging macroeconomic context.
Right.
Inflation, we have a lot of pressure on cost. So more than ever, capital and money is something that we have to be really careful with. And for all our investments, we have to be selective. So the dialogue with sustainability is not always easy. We have to make some choices and arbitrations. But what we do is that we embark sustainability in these choices, and the voices of sustainability, the KPIs associated, are taken into account. Beyond the carbon budget I just described, these processes are embarked in our governance. When, for example, when we gather to decide on an external growth investment, because the story of Geopost is an M&A story. We conquered Europe by buying some companies. Mm-hmm. So before, when we had an investment choice to do concerning M&A, we only looked at financial KPIs. And now we also combine the financial performance, return on investment, with non-financial KPIs. That's the thing we developed within Geopost.
If I can radically simplify the proposition, you're a company that delivers an awful lot of parcels by land.
Yeah.
If you can convert your fleet 100% to zero emission, will it solve half your carbon problem? 2/3? Give us an indication. Like, how complicated is this problem for you?
Now, the problem is tricky because
less than half?
This is a matter of pace. This is a matter.
No, I know it'll cost money. Obviously, although we have our friend from BMW ready to provide the vehicles, I'm sure, at a handsome discount to support the environment and sustainability. But if I hand away the cost, I'm trying to understand how much are other kinds of emissions, other considerations beyond simply the moving of packages.
We have the moving of packages. Something we didn't tackle for the moment are the emissions associated to digital operations. We have a new vertical in our strategic plan, very closely linked with e-commerce. And we have a digital dimension that is growing more and more. On these specific issues, we didn't tackle the topic yet, but it's definitely part of our ambition and to-do list.
I see. So the picture is a little more complicated than I made it. Yeah. Fair enough. I'm going to turn to my audience. Since we have such terrific panelists, I want you to have a couple of questions for them. Do we have some microphones? I see a hand in the back there, a lady to my left. And then we can cross the aisle over and take the question there. Again, as always, please identify yourself and make it a good question. And I do think our friend is still here. Good, you're still here to us. The screen in front of me doesn't show your face, but I'm glad to know you're with us. So by all means, direct it to any of our speakers that you wish.
Thanks very much, Vijay. This is Kellyanne Kelso. I'm with the University of Cambridge. My question is directed to Karthik.
Better watch it. She's a Cambridge person there.
Not everyone is perfect.
Wrong way to start there. He's off on a bad foot.
I had that conversation with them too. I was like, sorry about that, guys. This method's great. They loved it. So, as you've beautifully pointed out in the past, Karthik, who is involved from the SEC pre and post in sitting around the table and shaping our calculation methods has a profound impact on market outcomes for any accounting convention, be it carbon or finance. If we assume, we didn't go into this, but if we assume that reliability will encounter some resistance by upstream suppliers, rational or not, for adoption, who do you feel are the right stakeholders to incentivize faithful calculation and disclosure, and what mechanisms might they use?
Okay, right. So what if they don't want to do it? Well, who's going to do it? Who's going to wield the big stick? Or provide carrots, if that's the answer.
So I think there's both a carrot and a stick approach to this. Let's start with the carrot, which is, once we started running these pilots with companies, the reason they were interested in it is that they could start competitively differentiating their products, right? You take something like cement. One of our pilot companies was Heidelberg Materials, one of the world's largest cement companies. The formula for cement has been the same for 200 years now. So there's is, you can think of it as an ultimate commodity. But once you can start measuring the CO2 embedded in a bag of cement, then a commodity is no longer a commodity. That becomes a basis which you can competitively differentiate. Because there will be some customers, not a lot of customers at first, who will be willing to pay a premium on that, right? So now you can do that with cement, you can do that with steel, you can do that with oil and gas, because a barrel of oil is not a barrel of oil. There are different CO2 embedded in each barrel of oil from the extraction, refining process, etc. You can do that with basically any product or service. So if you are what we would call a high-type firm, a firm that wants to compete on this dimension, then there is an enormous competitive advantage to invest in decarbonizing your supply chain.
But the carrot here is the price premium, which you could pass on some of the extra profit or margin to the supplier. That's how you get them on board.
Exactly.
Okay.
And eventually there will be some subset of consumers that want to buy this, right? That's where that impetus comes from. So if you can start with that, then that I think is, because if you start with the stick rather than with the carrot, you set yourself back, immediately. So just pragmatically, it's good to start
with carrots.
Carrots.
Keep a stick nearby, though. I saw another hand there. Is the microphone still there, or has it moved on? I guess whoever it is, let's get to the next question in the interest of time.
Thank you to the panel for an excellent discussion. My name is Remy Sang, and the question is for Stephanie. Stephanie, from the lens of a CFO, I was wondering if you could walk us through your thought process as you're working with your CSO in terms of approving initiatives that may not be low-hanging fruit, that could require more significant upfront costs and more long-term gains. How does that, get over the hurdle for you?
Yeah, as I said, it's really for example, on the carbon budget. That's the example I took. But the combination of the dialogue between CSO, CFO is all along the way. From the moment when we report on our financial performance, which was the case for the first time for Geopost yesterday. In the press conference that we held for our full year results, we have this discussion, for example, to be sure that the non-financial data are secured, audited. We have this level of demand that we replicate and for which we help also the sustainability community. In the budget dialogue, as I said, things are not easy. And the thing is to find the right pace between the way we decarbonize, which is for us a license to operate, and the costs. Because as a CFO, if the costs are too significant, I will have to make some choice. So not too slow, not too quick, and in the right financial dimension. So the dialogue is, we are at the beginning of that. So I want to be very humble and realistic with you. We are moving and learning. We are on a learning curve and building a constructive dialogue with sometimes arbitration at the highest level of our home by the CEO and sometimes also by the shareholders. So we are learning, progressing, and integrating sustainability in the budget process, in trajectories, forecasts, because I think in the learning curve for non-financial topics, we have to be as accurate as we are, for example, for financial trajectories, to anticipate what will be the needs and be more reactive to prepare to do sometimes tough choices.
Well, the fact that you have the decision makers involved tells me that it's not just wishful thinking, that you're costing it, you're thinking about trade-offs, and ultimately that it's harder to make that decision, but perhaps it might be more sustainable. Let's go to that question there, the person who's been very patient. We're almost out of time, so a quick question, please.
Hi, I'm Dash Marinidis. I'm from Virgin. My question is it's really nice to see that carbon's having its day and carbon accounting is being taken into consideration. But at what point do you actually start accounting for the social costs in your license to operate? And at what point do you start accounting for the social and human aspect that the business is involved? Because from what I can see, the models that we've been built on from the 1920s actually don't stand up today.
Okay, so I'm going to give that to our professor, who brought up the 1920s. Will we have to wait another 100 years before we go beyond a specific greenhouse gas accounting to the broader social cost of business and a license to operate? And I would say, just to make the argument we've made at The Economist, there is also a social benefit. Business not only has costs, it also brings benefits, but a proper accounting of business impact on society. When's that going to happen?
Yeah, so I mean,
in 30 seconds.
when we started with this, the reason we focused on carbon accounting is because climate change is the existential challenge for the planet as a whole. There are lots of other problems. Biodiversity is a problem. Income inequality is a problem. All these other things, don't want to take away from it. But this is an urgent problem. It's existential to human civilization as we know it. So that's what we focus on. Think of it as a pilot flying a plane. You have a metric for airspeed, for altitude, for fuel gauge, etc. You don't want to say, look at one and not look at all the others. You have to look at the whole body. But right now, the moment is to get carbon accounting right, because that's urgent. So not to say that these other things are not important, but that's not the priority at this stage. That's how I'd frame it.
Okay, we'll have to reconvene in the year 2124, where we will ask the same question again of our distinguished panels. We are well beyond time, so I'm afraid we're going to have to draw it to a close. We're about to go off to lunch, but let me thank our panelists, including Thomas, who zoomed in. Thank you. We appreciate it.